the way they think about money and wealth, real estate investors have much more of a cash flow focus than the accumulation model that, kind of we're all taught when it comes to investing in, stocks, bonds, index funds, all that kind of a thing. That is more based around building up enough of a pile of assets so that when you're eventually ready to retire, your pile will be big enough so that you can sell pieces of it off gradually and pay your bills.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, we're always looking at different investment classes and different investment categories. Well, the show started, I definitely was a precious metals investor, still am to this day, have not given up faith or hope in it at all. And I've done quite well in it, but I've done well in other asset classes as well. So the point is everybody's different. Your situation is different. And you need to look at the overall scheme of things when you're deciding where to allocate your scarce capital. Well, we have a new guest on for you. He started out investing in the market, Taylor Loht. In 2015, he had an epiphany. And at that point, he switched his investing over to real estate, to both multifamily and storage facilities. Taylor, it's great to have you on the show. So in 2015, you had this epiphany. How did this come about?
Well, around that time, thinking back, it's been a little while now, there was the big price crash in oil, which didn't hammer my portfolio, but it pointed out to me, it showed me how much the performance of my investments was out of my hands. And in the investing world, that's always the case to some extent. But when we buy real estate, we're really buying a business that we can run and operate and have fundamental control over, which completely changes the what aspect of it is within and without of our control, if that makes sense. I was really noticing how much of it was out of my control. And I was kind of tired of the volatility of Wall Street, and also seeing that when we invest in like publicly traded securities as compared to real estate, we can't control what happens with those businesses when we buy a stock out there. But when we buy a piece of real estate, we're in the driver's seat, right? We're making decisions about not only the property that we buy, but what renovations do we make to the property, and how do we handle evictions? What property manager do we have in place? Everything around that is just completely a different ball game from buying stocks and bonds.
Okay, so I get that. You wanted more control over your future. And look, Wall Street exists first and foremost to feed Wall Street, to feed the interests of Wall Street. And the client is always coming behind the interest of the broker or advisor or whomever. Yes, there are plenty of well-intended financial planners out there who aren't getting paid by every other company that they put you into. But look, even when you go into an ETF, you got 0.2 or 5% expense ratio. You go into mutual funds, annuities, and things like that, the fees can be far, far higher. Doesn't sound like a lot, but when you factor that in over 10, 20, 30 years, you see that Wall Street gets the lion's share of the profits, and you come in second always. So how has it worked out for you having this epiphany, Taylor?
Oh, it's going great. One of the things that you learn once you get into the real estate investing world is how differently successful real estate investors think about money and think about wealth. So first off, thinking about money, successful real estate investors have a successful mindset. They have an abundance mindset. They don't have this scarcity mentality, even though we aim to invest in scarce assets where the supply is limited and demand exceeds the supply and everything around that. As far as the amount of success that is out there to be had, we don't see it as a limited function, right? There's enough out there for everybody and who's willing to go and get it. But going beyond that, the way they think about money and wealth, real estate investors have much more of a cash flow focus than the accumulation model that, kind of we're all taught when it comes to investing in, stocks, bonds, index funds, all that kind of a thing. That is more based around building up enough of a pile of assets so that when you're eventually ready to retire, your pile will be big enough so that you can sell pieces of it off gradually and pay your bills until hopefully you die and you have at least some of your pile left rather than running out before you pass away. Whereas for real estate investors, the goal is much more focused around building up enough cash flow to cover your expenses or massively exceed your expenses once you get to that point, so that when you're in a phase where you want to retire, get out of the hustle, whatever your hustle is, that your income, your cash flow from your real estate investments covers or exceeds your expenses. And if you have to sell something off, it's because you choose to, it's the right time, rather than I need to sell this off to pay my bills. That's not to say that can't happen. That certainly can happen, but real estate investors, generally speaking, would consider that not to plan, right? We want to have our cash flow cover our expenses rather than the other way around. And that model of investing, I have Rich Dad, Poor Dad behind me. Many of your listeners might be familiar with that classic book. He talks about that quite a lot in that book as well, but very common mentality in real estate.
All right. So what's the worst deal you've ever done in real estate?
So it was my first one, actually. So the first deal that I invested in, I started as a passive investor in multifamily properties because I had built up this nest egg in Wall Street and it had done well, but I decided to make this pivot. So I had capital ready to go. Spent some time researching how do I want to invest in real estate. And the thing that stuck out to me right away was multifamily properties is what I still invest in today. So spent some time networking and meeting with operators, learning about the asset classes, and met this operator that I thought, okay, I'd like to invest with this guy and this team. And so I invested in a deal that was 2 apartment complexes in Atlanta. That was in 2016, I think late 2016, if I remember correctly. Invested in the deal. And long story short, the property manager ended up stealing some money from us. And normally that's not great, right? That's a problem in its own. This was complicated by the fact that the owner of the property management company had general partnership shares in these properties. So he was part of the operator team, essentially. And as soon as the main person who was running the deal found this misbehavior on the part of the property manager, they were terminated. He did all the right things, but the kind of muddied waters of who owned what and how he had general partnership shares led to a couple of years worth of legal battles and arbitration, so that, we lost out on quite a lot of cash flow. Fortunately, we were saved by the market, to be honest with you. Even though the deal went sideways, the market continued to appreciate. So we got out profitably, but it was a lot less than we'd really expected and a lot less than I think would have been possible if there hadn't been this huge distraction, legal battle, and all the associated, bills and headaches around the behavior of the property, misbehavior, of the property manager. So that really hammered home to me very early the importance of, having the right people on the team.
Mm-hmm. All right. So I'm going to tell you first lesson of business, according to my father, and that Lutz. First rule of business: anytime you go into a new business, you pay for lessons.
That's true.
And what you're describing, your virgin deal, you paid for lessons, right? And hey, you didn't lose money. So actually you got paid to learn, although the profit wasn't as big. So just look at it from what you should have made to what you actually made. That was tuition, educational expense, and you could have written it off, right? I mean, because I assume you didn't make that mistake again.
Certainly not. No, that informs, the way we do deals today, what I invest in today. And, hey, one of the upsides is I get to tell folks like your listeners about what happened and spread the knowledge, and hopefully that comes, it has value to somebody out there.
All right. And my first law of business, Kerry Lutz's first law of business is you will spend in business the majority of your time doing the things you like to do the least, at least when you're starting out. That is a guarantee, whether it's invoicing or customer handholding, whatever it is that you hate doing the most, that is what you will be left doing until you create the systems that enable you to free you from that slavery.
That is a great point. And that's something that, there were a lot of things that I was doing years ago that I didn't like to do because they need to get done. And as I've grown and reinvested in my business, I've hired people to handle those things. And I've constantly looked for what is the next thing that I'm doing that I could hand to somebody, I could hire somebody for, I could give to my current team, or what is the next thing that we're not doing that I don't want to do, I'm not going to do consistently on a day-to-day basis because I have other higher value distractions. So yeah, it's a great point. Totally true. And hiring, building my team has been a key part of, growth that I've had in multifamily.
And the way that you avoid not doing the things or avoid doing the things that you don't want to be doing that aren't the best use of your talent, because if it was a great use of your talent, you didn't like it so much, but you see the value is, first thing you need to do, how much am I worth an hour? All right. Is it $10, $25, $50, $100? At one point in my life, I was worth probably $2,000, $3,000 an hour. And then it's like this job that I really don't like doing. How much, if I was in the market, would I get paid to do that job? And if it's less than what you are worth, then you are basically doing a job that you shouldn't be doing because it's beneath your pay scale. And you should always be asking. Now, look, if you're starting out, you don't have any money, you don't have adequate finances, that's one thing. But if you have the money and you're just being cheap, you're just stealing from yourself. I'll give you, for instance, good friend of mine, content producer, and got into YouTubes. And he was complaining to me, I just spent 8 hours putting together this video. And I said to him, hey, look, I know what you're worth here. We're doing work together. You're worth somewhere between $250 to $500 an hour. All right. So that means you spent 8 hours putting together a video. I know you did a great job. I still don't think you did as good as someone else who's a pro, but I know you did a great job. But it cost you somewhere between $2,000 to $4,000 to do that. It would have cost you $300 to $500 to pay a professional editor. And honestly, I said, hey, people actually go to school to learn how to do video editing, and they'll do it much faster than you as well, because they got templates, they got all the tricks. So I persuaded him, said, hey, you see, you shouldn't be doing it. And then like 2 weeks later, found a video editor. The guy was a real pro. And he said, Kerry, you're like so 100% right. I said, now you have to look at the other stuff that you're doing and get somebody else to do that too, because you're blowing a lot of time. Time really important. A question for you, Taylor. How do you find deals?
So early on, it was really hard. I had a really hard time. Now we have a network that has been built up over years of basically folks who bring deals to us. We build up these relationships, get to know people, vet people, do deals with them. And then over time, you just build up deal flow. But it's really hard at the beginning, especially in the commercial space. And a lot of that has to do with, okay, if you've never done a deal before, then it's hard to go to a commercial broker and demonstrate to them that you're able to close on a commercial deal. Why is that important? That is important because commercial real estate brokers control 80 to 90% of the deal flow, particularly in multifamily, in any given market. There's a handful of brokers who will control that deal flow. Now, you can certainly go off market. It's going to be a big hustle to find a deal and get a deal done. These brokers really specialize in that. That's what they're paid for. So it's hard at the beginning, but building up your network over time, you're putting in the work, you can make it happen. But it takes a while, and it's a slog there at the beginning.
So networking really essential. So I asked you your worst deal. What was your best deal?
Let's see. So I'm in a deal right now, a self-storage property in Texas that is going to be sold soon, within the next couple of months. And my capital is probably going to, once I get back out, I'm not sure of the exact percentage return, but what we're expecting is probably 2.5, maybe 3x. That deal was done back in 2019. So we've held it a little while here, and it's done pretty well. There's quite a lot of value add done on the deal. Really healthy timing, good location between two major markets. So that'll probably be the best deal. We'll see. I mean, we're holding a few others now that have been acquired much more recently that won't be sold for a few years. So only time will tell on those. But, it is boiled down to, having the right people in the right place, investing in the right location at the right time with the right strategy, all those pieces being in order, and then just, buying real estate and waiting, honestly.
Okay. And so let's look at, obviously, real estate. It's really thousands of markets across the United States and different sectors. So the least favored real estate market now, office buildings. Is there any way to make money off of that type of commercial real estate?
That is a good question. And frankly, I'm probably not the best person to ask because it's so far outside of my strategy. Kind of going back to what we talked about earlier, is I invest in scarce assets that have high demand. And the problem with offices is that equation is flipped, right? Many markets have too many assets and very little demand. I would like to see, and I'd like to find someone who is doing office to multifamily conversions. I believe in my heart of hearts that is a viable business strategy. If you get the building at the right price, I think, there's just so many markets that are ready for that strategy to work. But again, you have to get the properties at the right price, which might mean some pain for today's office investors and taking a big haircut on their investment. But personally, it's not what I invest in because, we can survive without offices. It's been years of folks working from home. I know some people have different feelings about that, but I think we're in a different era now.
Okay. So number two, of the disfavored real estate, shopping centers, malls, particularly strip centers, still doing well, right? Supermarkets still doing well, but malls, enclosed malls, or even outdoor malls, if they haven't repositioned into entertainment centers, they're basically shuttering.
Absolutely true. And that's a matter of shifting consumer demand. So I live in Richmond, Virginia. We have one mall here that has been converted to add multifamily essentially attached to it. And I think, frankly, that's the change that is going to need to happen to keep some of these malls just as viable, properties that have any value because, I'm a millennial. They say how awful we are. I mean, I'm in my mid-30s, right? I'm married. I'm an adult. We're adults now, right? And we are not going to malls. We don't go to malls. We shop online. So those assets need to transform, is my opinion.
Okay. And you see the repositioning where, like you say, where there's actually shopping centers with residential above it. There's an outfit. They're in Austin, but I think they're around the country, Domain. And that's what they do. Very chic looking shopping spaces with like an Apple store in the mix and other restaurants and clubs and that type of thing. And then you got that there. So that's interesting. Obviously can't be done everywhere. The only place retail's really doing well is in the South, the malls, Florida. But even here, we've got some duds that have to, where I live, that have to be repositioned. So then we get into like trailer parks. Now, those have been like a real popular very, it's attracted a lot of capital, particularly from hedge funds, because these large cash on cash returns. I know we were talking pre-call. You said you haven't gotten into any of them at this point. You think if the other markets you're in dry up, you might look at one?
I think it's possible, never say never. There are several different segments in the mobile home park space. There's the kind of older properties that, we're kind of more attuned to looking for, right? Kind of the classic, what you might think of as a trailer park. And then there are newer assets that are oftentimes like retirement communities that are brand new that have, just essentially detached mobile homes on them that folks want to retire to. I understand. I think there's a few of those that have gone up over the years in Florida and other more coastal markets. Mm-hmm. Personally, I see a lot of still fragmentation in that market, a lot of mom and pop owned assets, but many areas, many municipalities have, they really have it in for these mobile home parks. And there are a few reasons for that. There's a perception, of course. Many of us have probably seen the show Trailer Park Boys. Great, funny show. And
I never saw it. I got to check it out.
It's a great show. It's very funny. Set in Canada, but still it applies to the U.S. So there's the perception of, say, crime. And then on the other hand of that, you could just look at it financially. Mobile home parks, they generally have low tax assessment values. They don't bring in a ton of revenue to these municipalities. So there's the financial incentive for municipalities to kind of try to squeeze those mobile home parks out and have them redeveloped. So there's a few problems with it. I'm not saying I'm opposed to it, but any business plan has to make sense with those realities in mind.
Yeah, they're like low revenue, high services, particularly police department. That's the stereotype there for sure. And it does apply to some, not all by any stretch. There's certainly some within the city that I live in. There's a couple of them, but they're high end. A unit there, it's more modular, I guess, than trailer, but a unit there could go for $500,000. I mean, that's not your redheaded stepchild's trailer park, So interesting. But you gotten into storage. All right. I like storage. You don't need a lot of management there. And basically the money just comes in. And when they stop, then you call in the guys from Storage Wars and they sell it off there. Do you have like regular sales in your storage areas, your storage properties, where you wind up selling off abandoned lockers?
So I'm fortunate that with our investment model, I get to stay out of the day-to-day. That was one of my big goals, because going back to your comment about the value of your time in terms of dollars per hour, I think that's a big mistake that a lot of folks make, generally more on the residential side, buying single families and trying to self-manage. And, we all know like doctors who own rental properties and self-manage, and like my friend, your time is valued at hundreds or potentially thousands of dollars per hour. Why would you go self-manage a rental property? And I've applied that to my own real estate investment model as well. So honestly, I couldn't tell you how often, we're having to auction units off. I'm certain it's happening. In reality, it's a lot less exciting than in Storage Wars. People often just kind of keep junk in these units. Yeah. But it's not just predominantly junk. There are businesses that often, take advantage in many areas of climate controlled storage. So, there's a pretty diverse demand base for self-storage out there.
What kind of returns are you getting on your self-storage properties?
So I would be kind of generic about what I might want to say publicly.
Yeah, sure. I don't want to tax return.
If I looked at a deal that was below like the teens, I would not be interested in it personally. But I don't know if I want to get any more specific than that.
Okay. That's cool. Hey, risk in storage properties. What are the biggest risk factors that you face in A, buying one, an existing one, and B, building one from scratch? I didn't even ask you if you actually developed them or not.
That's part of the model. Generally, what we invest in, though, is existing properties with expansion potential, where there's demand in the market and there's also empty space on the lot that we can build into. Well, I perceive the biggest risk in self-storage generally that many markets, especially primary markets, are overbuilt and have been overbuilt over the recent years in that, it's relatively cheap to put these properties up. So there was a lot of money going into putting those properties up, kind of irrespective of the amount of supply and demand. So buying a property in an area that is overbuilt in self-storage, I see as a much higher risk than in, say, multifamily, where most major metropolitan areas, even secondary and tertiary, don't have enough housing, right? You still have to quantify that when you're doing an investment, but that's just kind of the reality, is most areas are undersupplied multifamily, whereas self-storage, some are oversupplied, and the demand dynamics are so different in that self-storage is more dominated by, in terms of demand drivers, by drive radii, like basically how far do you have to go from the property and how much population do you have in that area. Generally, folks will talk about and will focus on 1, 3, and 5 mile drive radii, which you can map out pretty easily. There's also some advanced tools that'll look at drive times, which is a bit different from drive distances, 5, 10, 15-minute type of things. But supply and demand, I see, is really the biggest risk in self-storage.
So therefore, really more so than a multifamily, calls for a pretty serious market analysis before you pull the trigger. And then you want to look for a value add where you can increase the existing number of units there, because, like you said, the construction costs relatively low.
Yeah, and if you can't do that expansion right away, you want to be able to, cover your debt and everything. You don't want to be in a position where you have to do that expansion in order to keep the property, right? That's not a good situation to be in.
That's a no-no, because you got to get approvals, and a lot of towns are unfavorably disposed to storage properties, even though they are like on the amount of services that they require from the government. They're really at the low end, aren't they?
Yeah, I think probably I'd say mobile home parks are still less favorable than self-storage in terms of, government preferences. But yeah, storage is not generally high on the list of what they want to see developed.
Yeah, so you got obstacles, but it all depends whether you're dealing with municipalities, counties, and all that, right?
Right.
So it's specific to the jurisdiction. All right. Well,
and how business friendly are they and all that?
Yeah, exactly. So Texas areas, lesser developed areas of Texas, they're probably more favorably disposed than coming into Miami Beach. But, prices are so high. So the market really determines the appropriateness of the use.
Right.
All right. Hey, well, we really appreciate you coming on. I know you've got a site, passivewealthstrategy.com. Is that the best place for people to find you, or where else can they connect with you?
Yeah, absolutely. That's my podcast website, the Passive Wealth Strategy Show. New episodes every Monday, Tuesday, and Thursday. Go there to learn more about the podcast, potentially investing with us, or get in touch.
All right. Hey, if you got a question for Taylor or myself, shoot me an email, kl@kerrylutz.com. We'll get you an answer quick. And while you're at the site, you can find financialsurvivalnetwork.com. Show notes to this interview. We've got a link to Taylor's site right there. And while you're there, sign up for your free newsletter. Taylor, a pleasure. Really appreciate you coming on. And perhaps we'll talk to you again in the future.
Sounds great. Thanks for having me.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.